Welcome to this video presentation, How to Avoid Getting Burned in the Markets, presented by FFR Trading. In this series, we'll equip you with practical trading and investing knowledge while helping you to avoid the many pitfalls and mistakes many traders and investors make. In this week's video, we'll talk about 8 common investment tools you can use to help you make a better informed decision regarding which investment or trading vehicles might be best for you. But first, let me introduce you to who we are here at FFR Trading and what our role is. FFR Trading is a due diligence firm for various investment and trading strategies. We've worked with dozens of traders in all markets, including stocks, options, futures, and Forex. In a nutshell, we've uncovered the mistakes so many people make when considering trading or investing strategies. Our goal is to find solid investment and trading opportunities that we can pass along to you. We hope that this video can help you avoid some of the pitfalls many investors fall into and help provide a primer on the markets, though not a comprehensive thesis on the subject. For advanced education on the markets, we'll discuss the unlimited literature available on specific topics. Chapter 2: 8 Common Investment Tools. The purpose of this video is not to cover each tool in detail, but to briefly highlight the pros and cons of each strategy so that you can make a more informed decision about which investment or trading vehicle is best for you. Keep in mind that entire books have been written on some of these subjects. The 8 subjects are brokerage accounts, auto trading, managed accounts, self-taught, books, DVDs, educational courses, and gurus, market newsletters, commodity trading advisors, financial advisors, and real estate investing. First, let's talk about brokerage accounts. To trade in any market, you must have a brokerage account. A brokerage account is an agreement between a brokerage firm and the investor. In it, the investor is allowed to deposit funds and place investment orders through the firm. The brokerage then acts on behalf of the investor and handles the transactions. The assets in the brokerage account are owned by the investor, who is usually required to claim capital gains from the account as income. Some of the pros: brokerage firms are licensed and regulated and are required by law to tell the truth. In addition, trading commissions are often negotiable, which many people are unaware of. Some of the cons: brokers are in the business of making money, and that can only happen when you place trades. Unscrupulous brokers may call you when they want you to trade, saying things like, "You should really consider buying Netflix right now." This tactic is called churn and burn. The more trades you make, the more commissions a broker makes. A bad broker doesn't care if you win or lose, only that you're trading. The bottom line is that brokers typically do not have your best interest in mind. Next up is auto trading. Monthly subscription auto trading, also called automated trading, is a service offered by many brokerage firms which allow a broker to place trades on your behalf. You don't have to manually execute the trades yourself. Instead, you allow a trader or signal service to send signals directly to your broker, who in turn enters and exits the trades. Most brokers don't charge extra for offering auto trading. Companies who sell auto trading subscriptions do not have to be licensed or registered with any regulatory agency. Some of the pros: auto trading signals are usually inexpensive. Monthly costs on average range from $50 to $200 per month. You generally keep 100% of the profits made in your account. In most cases, there are no long-term commitments. You can buy signals month to month and cancel at any time. You don't have to watch the markets all day, and you don't miss a trade. Some of the cons: monthly trading signals are not always designed by professional traders. Software developers looking to make a quick buck can bang out numerous auto trading systems. Many people who buy monthly auto trading signals have a get-rich-quick mentality and only subscribe for a short period, such as 1 to 4 months, and then quit when their tiny account hasn't doubled. Many quit just after 1 month. The truth is that 1 month is simply not enough time to gauge possible long-term success of any trading system. Additionally, many auto trading signals don't work over the short term. You might join the program on a down month while the next subscriber joins on a winning month. The reality is that you need to give it time, and your trading account should be large enough to allow you to trade the system over at least a year. More on trading account size in Chapter 5. On the annual subscription side, some auto trading systems are sold on a yearly basis. You commit to a full year of receiving and acting on all trading signals, which encourages you to give a strategy time to perform. Some of the pros: with an annual subscription, the caliber of the trading is usually higher. A trading professional trades your money via auto trading through a broker, like he trades his own money. If he buys Microsoft, you buy Microsoft. A 12-month subscription is often sufficient to recoup the cost of your subscription and make money, but not always. You also get to keep 100% of the profits. In addition, sometimes there are performance guarantees and tax write-offs that can be classified as educational materials or research. Some of the cons: yearly auto trading subscriptions are expensive, and you're locked into a 12-month contract. If you exit early, you deny yourself the ability to recover the losses that compelled you to exit. This is especially true of breakout trending systems. Managed accounts. A managed account is an investment account that is handled by a professional financial manager, but it is owned by an individual investor. Unlike auto trading signals, which are sent out to all subscribers, managed accounts are personalized investment portfolios tailored to the specific needs of an account holder. Some of the pros: well, there are often no upfront fees to get started with a managed account, and you receive a percentage of the profits based on a high water benchmark. Some of the cons: managed account brokers make commissions based on number of trades and percentage of profits. Their interest, similar to that of brokers, is often to churn and burn the account. So even if you lose, they get paid. Next, self-taught. This is the do-it-yourself approach to trading, where knowledge is gained by reading books, buying video courses, attending seminars, or online webinars by trading investing gurus. Pros: instead of blindly trusting someone else's trading system, if you find a proven strategy, you can learn the details of the technique yourself and trade it at will. You have the ability to go back and constantly review and re-educate yourself. Ideally, you learn how to trade yourself rather than relying on the expertise of another. There are also tax advantages to this approach. Some of the cons: well, in most cases, a simple proven technique from a trading or investment guru is not easy to apply on your own. There are many nuances to each technique that can never be conveyed in a classroom setting. They can only be learned in the school of hard knocks, i.e., a live trading environment with real money. Most trading and investment books don't include an actual step-by-step roadmap to real trading and are instead just general information that you can find anywhere. Books, DVDs, and webinars can't teach real trading world experience. The bottom line is, if trading and investing on your own was easy, everyone would do it. Market newsletters. Market newsletters are newsletters you receive via regular mail or email that offer market insights and trade picks. Some of the pros: market newsletters are usually affordable, and some good ones do exist. The cons, however: the challenge with market newsletters is that even with the good ones, it's all in the numbers. You may not always be able to trade every pick that's recommended. If you happen to miss a big winner or a string of winners, but take the losing trades, you may end up losing money on your account, even though the overall newsletter gains were positive. If a newsletter offers 60 trades a month, will you really be able to take them all? The trades you end up with selecting can radically skew your returns. Market newsletters can often show deceptive track records. They fail to consider appropriate account size, market slippage, and commissions. Some track records show compounded returns, which is even more deceptive. Next, we have commodity trading advisors. A commodity trading advisor is an individual or firm registered with the Commodity Futures Trading Commission, who receives compensation for giving people advice on options, futures, and the actual trading of managed futures accounts. Registration for CTAs is done through the National Futures Association, a self-regulated organization responsible for reviewing and accepting registrations. Some of the pros. Well, CTAs must be licensed and are regulated by the National Futures Association. CTAs can use different strategies to trade, and good ones will utilize the ones that work the best. Some of the cons. Well, CTAs sometimes show compounded returns. Compounded reporting, where profits are pyramided on top of one another to show large gains, is misleading and skews the results to show higher returns. As an investor, if you're unable or unwilling to compound your account to place the recommended trades, you'll not achieve the same results. Then there are certified financial planners and advisors. Certified financial advisors and planners are required to take challenging exams in financial planning, insurance, taxes, estate planning, and retirement. They must also complete annual continuing education programs to maintain their certification. Some of the pros. Certified financial advisors tend to be traditional and conservative with their investment strategies. They look at your long-term goals and retirement considerations. Returns may yield 8 to 10% per year. Certified financial advisors are usually cautious since they have vested interest in preserving your capital to retain your business for many years. On the downside, the single largest con in the Investment Act of 1940, which mandates keeping clients invested even in a down market to help avert yet another Great Depression. Remember that financial advisors make money on how much you invest. Keep in mind that they get paid regardless of whether you make money. They may make 8 to 10% per year for you, but this does not include their fees. Their investment strategies may be built on computer models, not actual trading. Financial planners won't show you actual client accounts, only projected returns based on their modeling. It's a fallacy to say that financial advisors offer more protection. Buying and holding for the long term isn't always a safe strategy. This approach means high exposure to your account. And finally, there's real estate investing. Real estate investing is simply the process of buying property at a low price with the hope of either making monthly lease income or by selling the property at a higher price. Well, some of the pros. Prudent real estate investing can result in consistent monthly income if you're able to find regular tenants. If you're able to acquire distressed property at a low price and have the money to fix it up, you can flip the property for a fast profit in a relatively short period of time. Many people simply do not have the resources to buy real estate in a down economy. But if you do, it's obviously a good time to buy. However, as you can see, there are a lot of ifs involved. Now, some of the cons in real estate. Well, real estate investing requires home repairs, maintenance, and dues. You also tie up liquid capital when you're fully invested in a property. Many people think real estate is a sure bet or a conservative investment. These terms couldn't be further from the truth. Ask any real estate developer. They will tell you that it could be a great investment, but the possibility of losing your shirt is very real. You may buy a property thinking the real estate market has bottomed out, only to see property values drop even lower. In conclusion, know that there is still money to be made in the markets. Take it slow. Find strategies that match your unique personality. If possible, work with a trading team or at least one other person. They'll be able to see your blind spots when you can't. Above all, don't trade with money you can't afford to lose. At the end of the day, it's only money. Your family, friends, and your health matter most. Aim for a balanced life. If you aren't getting some enjoyment out of trading or investing, then chances are you might be in the wrong profession. Well, thanks for joining us. We hope this video has helped you on your journey to success in the markets. If you would like to obtain your own copy of our book, How to Avoid Getting Burned in the Markets, email us at support@ffrtrading.com.